Good morning, Will. Good to see you on The View. Will, let's talk about the Australian Stock Exchange. I think that's of interest to all our audience. And we ended up last year having really strong November and December months. The beginning of February and January, not so much. How do you see the market at the moment? Is it offering value? Is it expensive? What's your view on current metrics?
Okay, and great to see you, Paul, and great to be back on The View. I guess like you, we talked about this yesterday, I think, but what's fascinating is when the pivot finally comes, or the perceived pivot, markets can really move. And as well, what's interesting about the moment, the term impending recession is really being replaced by the term Goldilocks as almost the most used reference to the current environment, and that essentially is talking about sustainable growth that's coming out of global markets. Even the US continues to surprise on the upside. And at the same time, we're seeing the indicators of inflation easing. So we've got reasonable growth, and actually the risk around further tightening in liquidity for global markets is reducing. So in that environment, markets can continue to rally. So the November, December months were quite extraordinary, from just the size of those lifts having a 7% increase is remarkable. But actually, how I see January and February is that it would have been quite natural to see a pullback in the markets, but we've actually seen consolidation and continued marginal outperformance. So I think that really shows the strength in the market at the moment. And I guess if I just take on the last point there around what are we seeing, what the market's telling us, valuations were compelling. Now they're more back to neutral. It's the job of the growth, of the earnings growth, to start to come through to prove whether or not people should be buying the market at this point. We do have a positive view on that.
Yeah. So we'll get to the reporting season and what you're looking for. We're just at the start of it, really. But before we go into that, I just want to get your feel for how important the macro environment is to you. A couple of things, we've already referred to the central banks pivoting from raising rates to perhaps contemplating reducing rates. We've had strong commodity markets. We're seeing decent growth out of the US. On the other hand, China's been very disappointing. How much do these big macro factors weigh in your portfolio construction, your stock selection, cash weightings in portfolios? Where does it all fit in, or are you very much bottom up, focused on individual companies and their profitability?
Yeah, it's a great question, Paul, and I guess through time, fundamentally we are bottom up stock pickers. We look to find companies that can grow really independent of the vagaries of the business cycle. But one thing we know is that you can't ignore the macroeconomic environment. So it's more of an understanding of the drivers and which part of the cycle which we're in, and depending on which part of the cycle, whether an expansion, contraction, does lead us to understand which sectors do well in those environments, and that's really key at the moment. So macro is more of we need to understand whether the companies we love are able to execute and be able to deliver the growth. Is this the time for them or not? And then also, when we come to construct portfolios, what we really need to know is how the aggregation of all the stocks we have in our portfolio, whether together they actually form. There's another view perhaps that we didn't see when we just putting the companies together. Have we ended up with the companies that are all likely to outperform when interest rates increase? And then, of course, at the end of last year, that portfolio would not have performed well during that period. So it's more of a growth, but also a risk within our portfolio construction.
And as we mentioned, we're at the start of the reporting season. Are there particular bellwethers, if you like, that you're looking forward to hearing from companies that are leaders in the industry, like Commonwealth Bank in the banking sector, or BHP in resources, where you really get a feel for how the sector is going to perform. So what are you looking for from this reporting season? And are there particular sectors that you're focused on, that we're going into the reporting season perhaps overweight or underweight? Give me a sense of what you're looking for in the reporting season.
So the reporting season is a great time to get under the hood of these stocks. And so with our process, as we narrow it down to a certain number of companies that we think could be in the portfolio, the number's around about 60, and then we end up with like a 25 stock portfolio on average over time. So look, we have a focus list of companies we really want to understand, but what we actually get reporting season is an understanding, as you allude to, of the drivers of the economy, what's happening, what can we learn from a company perhaps that we don't own that can give us an insight into changes within an industry or the growth drivers for another area of the market. So it's great to understand and look and listen to those bellwethers. So we will hear from CBA, even though it's not their time. They usually do a quarterly update too. So for us to understand the competitive outlook, CBA moved out of the being competing hard in the market, which allowed net interest margin to expand somewhat, but we need to understand whether that's still the case. And then also, it's a great read through for consumer health. So on that same theme, we'd be looking to listen to Wesfarmers with its Bunnings store footprint, and also I think at this point in time, given their underperformance last year versus the strong market, the supermarkets will be really interesting. They give you a read through to perhaps the benefits of the population growth we've seen. They're just more people here buying more things. Also, the inflation out, we get a read on whether the input prices are coming up and down, and also the wage growth as well. So there's a lot of indicators we can see from these large groups that can help us actually find ideas outside of those companies too in the mid and small cap sector.
Just to add a little bit to that, so consumer sentiment in Australia has been relatively weak for quite a long time. We've seen household savings kind of running down. A lot of the savings that were accumulated during the pandemic are close to being exhausted. Does that colour your outlook for consumer spending, for discretionary retail, or give us a sense of how you see the consumer and some of the problems that households are having meeting up with rents and very expensive housing sector, and so on, rising grocery prices.
Yeah, we think it's interesting. There'll be certain parts, there are certain segments of the consumer sector that are really doing it tough. And you can see the reactions from the government around the recent tax reforms they've put through and how they're reflecting of that. But then also there's other components, or other perhaps retirees and such, that are actually benefiting from this higher interest rate environment. And so to look at the average doesn't really give you an indication. So you're right, the low consumer confidence and still being able to have reasonable consumption is a little bit confusing. But what we've actually seen, while the amount of goods being bought are less, we've actually seen the willingness to pay those higher prices. And we can't deny the benefit of this expanding the amount of immigration, amount of people arriving in the country that's helped support the consumption here. So look, we have to, I think it's prudent to be cautious around the consumer, but there was a point in time to buy these stocks when their valuations were depressed. But over the last 3-4 months, we've actually seen some positivity come back to earnings expectations in the consumer space, as well as their valuations move higher. So as we move into reporting season, that is an area that we are cautious on. We think banks are in a similar vein where they've had a really strong run. So at this point in time, we think it's prudent to take some profits within those certain sectors. But there are other sectors that actually haven't had the performance drive. And so the other areas we really want to focus on are the supermarkets, as I've said, but also perhaps the beneficiaries of this big mining boom and that $130 iron ore price.
Yeah. So, let's talk about commodities for a second, because, the papers and the wires are filled with disappointing economic data coming out of China. It really seems like the real estate sector's in deep, deep trouble. Debt's a problem, demographics is a problem, consumer confidence is a problem in China. So, is this affecting your outlook for our commodity exporters? At the same time, the Australian dollar is pretty weak, which is good for the exporters. But how are we positioned in portfolios, and do we still have a focus on kind of green transition metals, or has that not really worked out the way we had hoped?
Yeah, two great questions there, Paul. So from a commodity outlook, it's very much been a different story across the commodities. Really, iron ore and coal to some level have been the stars. It's caught a many fund manager out this year to see what you're talking about, this slowing and labouring Chinese economy, but then to see iron ore from past 100 all the way up to 130. What we are seeing, which makes us still hesitant to be overly cautious around our producers, is that the Chinese economy continues to stimulate. They continue to increase measures. We're not seeing the big bang that we've seen historically, but I actually caught up with an iron ore related company last night as we move through this reporting season. And what the feedback is that the steel sector within China actually continues to operate at a high level to offset that declining growth. So as steel processing, manufacturing continues to be driven at a high level, the demand is there for iron ore for the next period. But also on the other side, we're not seeing the supply come through. And so Simandou is the next potential expansion. But at the moment, you really have to look at supply and demand. Demand's good enough, but supply is just not there to fill the gap as well. So we're selective. Now, on the green energy transition, we're going through a bit of a discovery phase of where, say, lithium, also the nickel. What is the price discovery? Where is the natural marginal cost of production for these types of metals? This is the first downturn we're seeing in lithium. We are seeing the cancellation of projects. That's actually usually a great indication of finding the bottom where it's not worth it. And so good producers such as Mineral Resources and Pilbara continue to be profitable at this level. So it's a space we're actually doing more and more work on, and we will continue to focus on that space. So long-term themes, short-term uncertainty, continue to be positive on commodities. But as I said before, we actually really are starting to look at the companies that will benefit from this spend and expansion. So the mining service space looks interesting to us too.
Okay, thanks, Will. We're getting to the end of our time. Time for one last question. We often get asked by advisors, clients, tell us what you've been buying lately. Are there any stocks that you can share your outlook for, stocks that we've been adding to portfolios where you think, these are companies that we want to get set in, perform well over the next 12 months? Any stock stories you can share with us?
Yeah, sure. Well, I'll be brief given the time, but I guess there's a couple of names that we like. We have, as I said, we have our hit list, and when they end up being an evaluation range where we can see a discount to intrinsic value and 20% plus upside, we move. So in the last week or so, we've increased our position in Worley. We think there's a medium-term opportunity from the capital expenditure that will come through, and we think the uncertainty that's come about through the delay in the large LNG projects within export terminals within the US under Biden it's been more than factored into the share price. So we like that thematic. Now here's one, the insurers as well. I guess everyone understands the insurance space and what they're seeing on their renewals. Significant increases in prices continue to come through, but what our job is to understand the global dynamic and understand global peers, and QBE is our preference in the space. And globally, QBE and its competitors are actually having really strong period of returns where the top line's growing strongly, but the claims are reasonably low. So there's a couple of stocks that we've been active in the last week or so.
Okay, that's great. So watch out for Worley and QBE. We'll keep an eye on those stocks. Will, a great pleasure to have you on The View, and to our audience out there, have a great weekend, and we will see you next week. Thank you, Will.
Great to see you, Paul. Thank you.